One of the most commonly asked questions is, how do I pay myself? This question is simultaneously complex and it's simple at the same time, but really it can be broken down into two different sets of situations. One being a sole proprietorship, LLC, or partnership, and the other being a corporation. For a sole proprietorship, LLCs, partnerships, there's really only one way you can pay yourself, and that's from distributions. A lot of times, business owners in these sole proprietorships, LLCs, partnerships think they need to pay themselves a wage because that's all they've ever known, but there's really no need for that. All you need to do is pay yourself a distribution, and the way that works is simply making a bank transfer from your business account to your personal account. It can be writing yourself a check. It doesn't have to be super complicated. This is called a distribution or owner's draw. If your business is a corporation or being taxed as a corporation, the answer gets a little bit more complicated. If you're in a corporation, there's 3 different ways that you can pay yourself. And really, it's a combination of all 3 in most cases. 1 is a distribution, and 2 is a reasonable wage, and 3 is an accountable plan. Now, distributions work a little bit differently in a corporation as compared to the sole proprietorship, LLC, partnership, mostly in the fact that you cannot give distributions in unequal amounts. And that is based on the total shares or percentage owned by each owner. If it's a single person that owns this corporation, these rules don't apply because it's just one owner. But if you have 2 owners, that's when things get complicated. In a lot of situations, you have 2 owners, they're 50-50, or maybe you have 4 owners that own a quarter apiece. In that case, each individual would need to get an equal amount of distribution. In other words, if you had 50-50 ownership and you gave a $100 distribution, each individual needs to get $50. And the reason for that is because in S corporations, you can't have multiple layers of ownerships. If you were to pay one person 60% and one person 40%, even though they own 50-50, it makes the assumption that one person has preferential ownership or owns a different class of stock, and you can't have that. Sometimes business owners get themselves into trouble with that uneven distributions, but as long as it's equal based on your partnership percentage or shares owned, you're gonna be in good shape. So that's a distribution. The next one is reasonable wage. In a reasonable wage, I will go over in a different video because this is also a question that I get from business owners. The reasonable wage looks different depending on if you're in an S corporation or in a C corporation. In an S corporation, you're trying to pay yourself as little as possible, while in a C corporation, you're trying to pay yourself as much as possible. And while some of this sounds complicated, a lot of it has to do with the incentives that are put in place based on what kind of corporation. So if you're in an S corporation, you want to pay yourself as little as possible without being too low to put you in the crosshairs of the IRS. If your wage is too low, you could be at risk of getting audited by the IRS, and any kind of distributions you have could get reclassed as wages and you'd owe more tax at the end of the year. Not good. Conversely, in an S corporation, you don't want to pay yourself too much because then you're paying more in payroll tax than you need to. And remember, the main benefit of being in that S corporation is that S corporations aren't subject to self-employment tax. In a C corporation, you're incentivized to pay yourself more as opposed to less than an S corporation. And the reason for this, it's just harder to get money out of a C corporation. Fortunately, I don't see this a whole lot. Corporations are pretty rare on the, small business owner side. So if you're in a C Corp, I'm sure you probably understand this. And the third way that you could pay yourself in a corporation is from an accountable plan. An accountable plan is basically a way of being reimbursed for out-of-pocket expenses that are business related. Things like home office expense, maybe a cell phone, mileage. These are all expenses that could be reimbursed with an accountable plan. And that's pretty much it. As you can see, depending on what kind of situation you're in and what kind of structure you're in, that answer on how to pay yourself as a business owner depends. My name is Ryan Beals, and I'm the owner of Ryan Beals CPA. We specialize in helping business owners save on taxes. This video is part of a larger set of videos that go over commonly asked questions from my clients. If you have questions about your business and how to pay yourself or how to save money on taxes, you can schedule a consultation online at ryanbillscpa.com. Hope you have a great day.